Alright, guys, so things are heating up once again. Today, we have to talk about the upcoming tariff shock. We'll also cover the dollar that's falling like a rock once again. Now, the China deal might be done, but Trump's chaos is far from over. He's reenacting the art of the deal playbook, which is basically issuing a big threat and freaking everyone out, then playing nice and giving trading partners a raw deal. And welcome to the new age of trade diplomacy. Now, Trump has confirmed that the US will be sending out ultimatums to economies all over the world, and the shock will be coming in just 2 weeks. Can no one see through these rules? He wants countries to come scrambling with their best trade deals, and the ones he really wants to see grovel are none other than US allies. Now, we are talking about Canada, the EU, and Japan. Vietnam, Taiwan, and Korea, they are also on the list. These are some of the countries with the highest tariff rates. We are going to be sending letters out in about 2 weeks to countries telling them what the deal is, and countries can take it or leave it. Now, this is a classic ultimatum and it's going to backfire badly on the US economy. The original plan was to try and contain China, but obviously that hasn't worked. We had a Taco Tuesday once again.
To open their markets to the United States separately of this deal. And when it comes to this deal, we're going back to the terms that were agreed upon in Geneva for the release of some of those critical minerals and the magnets from China to the United States. And we have agreed to fully comply with the Geneva Agreement as well.
So the fallback option is to punish everyone else. The agenda is simple: reshore essential industries back to the US using tariffs, and that's why there's a baseline of 10% no matter what. However, Trump also wants to collect a ton of tariff revenue. Remember that the big beautiful bill is going to add anywhere from 2 to 3 trillion dollars to the deficit, and the treasury can't borrow money without blowing up the economy. So the only option left is to tax the US consumer. Now, in May, the US government collected nearly $23 billion in revenue from customs. Now, the tariffs paid were more than triple the amount in 2024. And if this continues for the next 12 months, it could hit $250 billion. But realize who's paying for this? Companies and businesses importing stuff into the country, which eventually trickles down to the US consumer. This is a very important realization we must understand. The bill isn't free, it's paid for by the American people themselves to fund Trump's grand experiment. By setting the world an ultimatum, Washington is trying to win both ways. Countries can choose to manufacture in the US or remove their own trade barriers. If not, they sell less and US consumers subsidize the US government more. But there is a third option here that Trump isn't seeing, an option where countries just don't play ball. Everyone might not want to move shop to the US because consumers there are already weakening. In April, the trade deficit shrunk by a lot. Now, there are many pundits calling this a victory and that the US trade has turned the corner. But the data shows Trump is actually building up a new problem. On the right chart, we can see the import of goods and services fell by a record 16.3% in April. As a result, the US trade balance has rebounded back up to minus $61 billion. Now, that's not really an improvement, but a reversal back to the mean. The majority of the import slump, $33 billion, came from consumer goods. So now Americans are facing higher prices. Foreign imports are no longer cheap enough and they have to switch to domestic products that cost more. Meanwhile, the imports of industrial supplies and capital equipment also decline. Input costs have also risen in the US. As a company looking to move production there, you are facing a double whammy. Your local customer base is getting poorer thanks to the tariffs. At the same time, the cost of making stuff has risen relative to the world. It's very bizarre to understand why companies would reshore there. They won't be able to export anywhere else, they can only sell domestically, and the picture isn't looking good. According to the New York Fed, US consumers expect rent prices to jump by 8.4% in the next 12 months, and that's the line in orange. And in blue, food prices are expected to rise by 5.5% in the year ahead. Food and rent are the bare essentials. If more money has to be allocated there, can people really afford to buy other stuff? And that's why the ultimatum probably isn't going to work. Now, I'm sure some companies like Nippon Steel will reshore because they don't really have a choice. But for companies that do have a choice, building in the US is a dead end. For many industries, it's a risky move if US growth continues to stagnate. Now, during Bessent's testimony in Congress, he went back and forth. He was checked twice by Congressman Bayer. Now, Bessent believed economic growth was robust, but it was in fact half of what it used to be. Job growth also isn't solid at all. It's a third of what it was last year. And this is a major problem for manufacturers considering to relocate. It directly ties into Trump's ultimatum to the world. If US growth is robust, then there is an argument to relocate. And that's why a targeted tariff on specific industries like chips or automakers is more effective than just a global reciprocal punishment. But the cat is out of the bag at this point. Now, almost every credible institution is downgrading US economic growth. Major banks are doing that. The IMF has also revised their projection lower. And now the World Bank is the latest in line to downgrade Trump's economy. Mind you, this is a bank based in Washington. Now they expect US growth to drop by half, from 2.8% last year to just 1.4% in 2025. Compare this to the rest of the world, it's not a good number. Global growth is estimated to hit 1.8%. Now imagine asking a factory owner to spend hundreds of millions, maybe even billions of dollars to set up shop in the US. And if the tariffs stay, can domestic consumers recover? That's one pressing problem. But if the tariffs get repealed, then now you're the clown. Foreign imports will compete and they will win, all without spending a ton of money to reshore. So business uncertainty is one thing, but another problem against reshoring is the collapsing dollar itself. Now, a few days ago, the dollar index was hovering at 99 and it was already 8% down from the highs. But on Wednesday itself, we saw a big tumble down below 98. Import costs are more expensive, plus earning revenue in dollars is a bad deal for producers that need to take home their profit. Now, setting up a business is one of the most impactful things you can do in life. It gives you unlimited upside and allows you to challenge the limits. However, before you set up a company, are you doing it in the best location possible? We live in a chaotic world where the global rules keep changing. What you truly need is stability, a country where you have enormous benefits while knowing this won't change for decades to come. Starting a business remotely in Singapore and Hong Kong is one of the best decisions you can make. And with Osome incorporation in these tax-friendly regions has never been easier. Enjoy the benefits of doing business in these metropolitan cities with the tax advantages wherever you are in the world. The process is hassle-free and completely paperless. Osome will handle your financial administration, taxes, bookkeeping, and accounting. Best of all, with Osome's easy-to-use platform, you can track your cash flow in real time and stay on top of all those invoices. It's time to manage all your business finances in one place. No need for multiple apps or tools. Focus on delivering value to your customers and creating new products. So free up your time and get your business off the ground in Singapore and Hong Kong with Osome. Get started today and build a business that really matters. Incorporating in Hong Kong or Singapore, click the link in the description or pinned comment below for 16% off any Osome services. Let's start your business journey today. So what really happened here? Trump said that the China deal was a victory and nothing fundamentally changed there. We are still at the same ridiculous tariff rate of 55%. Well, Scott Bessent happened. He just gave two pieces of testimony that just collapsed the dollar strength. The first is his epic denial of how the bill will add to the national debt. Everyone knows that it does. Everyone except the Treasury Secretary himself.
The first question is, will the big, beautiful bill add to the national debt? Yes or no? Is that a yes or a no? That's a no? Yes?
Sorry?
What did you say? I'm sorry.
It remains to be seen.
And here's the problem. Earlier on, he already admitted that the federal deficit for 2025 will approach 7% this year. Yes, he blamed it on Biden again and how Trump inherited the mess. Now that might be true, but it still doesn't change the fact that US government spending is spiraling out of control. The US budget deficit for majors hit an incredible $316 billion, and that brings the annual shortfall to 14% higher from a year ago. In other words, more money will have to be borrowed from the global markets. Earlier on, we established that tariff revenue comes from US consumers themselves. They're going broke trying to fund Trump's bill, and asking them now to buy US bonds is a very very tough sell. Now, the big driver of treasury demand will be the foreign investor, and they are a fickle bunch. If US deficits keep rising, investors will demand a higher return, and that by itself is destabilizing for the entire economy. It's a big reason why Paul Tudor Jones is predicting the dollar to fall by another 10%. Even without Bessent scaring everyone in Congress, there's already enormous pressure on the reserve currency. Now, rate cuts are coming, maybe one or two cuts this year, but by next year, we can expect rates to drop rather dramatically, and this poses a very big problem. Right now, a lot of money is tied up in short term bonds. Many investors don't mind lending capital to the US government at 4% for a month or two. But what happens if rates on the short end fall? Will they be happy to take their capital and plow it into long duration bonds like the 10-year or, God forbid, the 30-year debt? The dynamics there are directly tied to supply and demand. The Federal Reserve has no control over longer term rates. And this is why the dollar might be trapped and headed lower. The Fed cutting and Bessent borrowing money makes the entire yield curve unattractive all at once. You get screwed buying a 3-month T-bill. You get hammered buying a 10-year bond. There's literally no escape unless Trump stops spending. And if the big horrific bill passes, we'll enter a period of perpetually high deficits, which directly translates to a bigger issuance of bonds, expanding the overall supply. Now, by 2026, we could hit 7.1% deficit to GDP. 2028 will be even worse, hitting 7.2%. Even until 2033, the deficit might still be over 7%. Now, these are just the estimates. If interest rates continue to stay higher for longer, the yearly deficit will be more than the figures here. It's why the US dollar is collapsing like no tomorrow. However, Bessent just made it worse. Now, we all remember Section 899 of the Big Beautiful Bill, where the US government can tax foreign companies and individuals on their US income. And this could include dividends from US stocks. It might even include interest payments from corporate and government debt. It's not confirmed yet, but it's a clear and present danger. As an investor, you have to take this very, very seriously. Would you invest money into US markets if Section 899 passes? The revenge tax could hammer you with an additional 20% on top of what you're paying today. And Bessent has also made it crystal clear that the provision is here to stay. But beyond that, there's another warning Bessent made that all bondholders should wake up and listen to. He just told the world that he will be running the US economy hot to drive growth at all costs.
As I said, I'm committed to changing the trajectory of this, and there are two ways to do it. There is through spending restraint cuts and through growth. And I think that is a very difficult calculus to achieve. We are trying to navigate that calculus. So, as you said, 3% growth will change the trajectory. What I have also said is we did not get here overnight. I have gained about 10 pounds since inauguration. I'm not going to cut off my arm to get back to my January 20th weight. I'm going to eat less, exercise more, and that is what we are trying to do with the federal government.
So there are serious fundamental reasons why the dollar is falling. The tariff war is a big factor. When you punish the world, it's going to be a tough sell getting them to buy your currency. But the bigger problem has always been the fundamentals of the US fiscal situation. The US is borrowing and spending more money amid a trade war. Not only does yields rise, it also risks higher inflation. Now, trying to target 3% growth when your consumer is collapsing only means one thing: more deficit spending. The money supply will have to increase, banking deregulations will also be coming. And you know things are really bad when even Janet Yellen is back scolding the White House. She expects inflation in 2025 to rise up and hit at least 3%. And that's a big rebound from where we are today, 2.4%, but it's really not impossible. And we should listen to Yellen. She is the expert of borrowing and spending money like no tomorrow as well. She was the architect of the 6.4% deficit to GDP during the last administration. However, it looks like Bessent is going to eclipse her. 6.4% are rookie numbers considering what's coming ahead. But let me know what you think. Will the world bow down to Trump's demands or will they resist? And can Scott Bessent really drive genuine growth? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.